Hello, this is Vince, and we're going to go through the Hartnett flow show. We have the full presentation for you today. You can read the words, and you can see the charts side by side instead of scrolling through them. And we'll also attach the PDF in the file. All right, here we go. Not too intense today, very informative, concise. I think he's just touching base on what makes a bubble, and that we're really not near a bubble popping yet. But you can decide. The flow show short history bubble. Scores on the doors. Crypto up 16.3%. Oil up 7%. US dollar up 3.3%. Commodities 2.8%. Stocks 2.6%. Cash 0.6. High yield bonds minus 30 basis points. Investment grade bonds minus 2.3%. Gold minus 3.9%, and government bonds minus 4% year to date. The price is right. Credit is the glue of any bull market. Investment grade bond spreads are tight as a drum, close to post-COVID lows of 86 basis points, despite a record $310 billion issuance. But equity bull is so narrow. Top stocks equal 75% of the S&P 500 year-to-date gain. Top three stocks equal 90% of the tech sector year to date. U.S. equity breadth currently worst since March 09. Table 2, chart 2. Very tricky. I have to go the other way. Table 2. And that's not what he wanted. He wanted chart 2. Sorry. Here we go. Chart 2. Worst equity market breadth since March 09. Okay, quick comment on that, or quick rephrasing of that. He's showing a contradiction between one aspect of bubbles and another aspect. And the one aspect of bubbles is that the breadth of a market narrows in a bubble, which we have. But the credit is the glue of a bull market, not bond prices, credit. So investment grade bond spreads compared to treasuries are as tight as a drum compared to each other, are as tight as a drum, meaning there's no shortage of credit or ability to borrow. So those two things are juxtaposed with each other. Tail of the tape, new consensus all-weather asset classes are corporate bonds and tech stocks. Inflows to both on course for blowout years. Year-to-date annualized 0.5 trillion to IG bonds, 85 billion to tech sector funds. Charts 4 and 5. Let's make this a little bit bigger. I think we can do that. There we go. Charts 4 and 5. Inflows of investment grade bonds on the left. Wow, that's huge. Look at that. All right. And on the right, inflows to tech on course for around 85 billion in 24. Also huge, but the investment grade bonds are even huger. I'd have to wonder if that's a contradiction or a collaboration, because investment grade bonds are down this year with all that money coming in, right? Scores on the doors. So we'd have to see what investment grade bonds were before the money came in, right? So the biggest picture, long, illustrious bubble history. South Sea, Mississippi monopolies of the 1710s. There we go. Dow in the roaring 20s, gold in the inflationary 70s, Japan in the 80s, internet in the 90s, China in the O's, great bond bubble of 14 to 20. Crypto, FANG, tech disruptor derivatives. No two bubbles are alike. Try blowing a couple yourself. But similarities to gauge Magnificent Seven today are catalyst, price, valuation, and price of money, which is what he's focused on here. That's table 1 and 2. Table 1 and page 2, right? Table 1 is, I went too far. Table 1 is there, right? You can look at it there. It's also right here. And we can go to the next part. But let's go through. Weekly flows, 600.6 billion, so 600 million from gold, stocks, money in, bonds, money in, cash, money out. Okay, so the cash peak is over. Largest outflow in 8 weeks, he says. Investment grade bonds Money in, tech funds, consumer funds out, material funds in, question marks after that by me. I wonder why. It could be domestic demand due to uh, build back better stuff, infrastructure. It could also be China on the back of China's stimulus. I think it's more so on the back of that, at least this week, because China stocks are doing well. All right, BOA Bank of America private clients, Bank of America bull and bear indicator. There it is. Now, significant in the sense that last week it was 6.8 on the way to 7, 7.25 on the way to 8. It was getting near overbought, but it's backed off a little bit. So he's saying it's not as overbought as it was. Now, the next part, I'm going to make this bigger now. So I wrote some notes on the side. I'm going to read this through. A short history of bubbles, all right? Catalysts, prices, valuation, and cost of money were his price of money, were his drivers, were his key comps. All right, catalyst, bubbles driven by technological innovation, new geographical sources of growth, and very crucial central bank easing. AI bubble was kickstarted by Fed response to SVB and ChatGPT, just as Plaza Accord kickstarted Japan. Long-term capital, the internet. 9/11, the housing bubble of the O's. COVID, $30 trillion of policy stimulus. Crypto, and so on. Even Mississippi and South Sea Company bubbles were caused by amendment to English usury laws in 1714, which forbade lending rates over 5% as UK and France needed to borrow to finance ceaseless war. No different today. Okay, catalyst. Ingredients include innovation, technological mostly, geographical growth, come back to that, and central bank facilitation. That's the bottom line there. The geographical growth means, well, in the examples of like the South Sea bubble, you have a new market to sell to, and that was the New World. You have a new market to sell to, the colonies. You have a new market to sell to, China opens. You have a new market to sell to, well, do we have a new market to sell to? And it doesn't seem like we really do yet, but there's got to be some sort of growth. Anyway, that's my opinion. Geographical growth does not seem as geographical as it usually is. We colonize Mars, there's your growth. All right, next. Price bubbles obviously mean huge trough to peak asset gains. Well, how big? 140% gain in the Magnificent Seven in the past 12 months is closing in on the 180% rise in the Dow Jones in the 1920s and the 150% for both Nifty 50 and 70s and Japan stocks in the 80s. But not quite 190% gain of the internet bubble, everyone's favorite comparison, nor the 230% surge in FANG stocks from the COVID lows. Remember, before the February sell-off. No exponential price gains and velocity or big deviation from moving averages are another classic symbol. The Magnificent Seven is currently 20% above the 200-day moving average versus the 30% oversold metrics of 9 equity manias covered in table 2. So pricing, huge trough to peak, 130 to 230% quickly, and a big move from the moving averages. Valuation. Trailing PE for Magnificent Seven is currently 45 times. It ain't cheap, but true that bubble highs have seen dafter valuations. 54 times for the Nifty 50, 67 times for Peak Nikkei in 89, 65 times for NASDAQ Composite in 2000, and a staggering 205 times for the NASDAQ 100, 60 times in 2021 for Peak FANG. So we're not there yet. According to this, I don't know how important this criteria is, but we're not there yet. I mean, that's inflation, right? The PE is not big enough yet. All right, bonds. Direction of bond yields are key bubble metric as abnormality of bond infects other assets and economy. Abnormality of bubble, I should say. In 12 of 14 observed bubbles, bond yields rising as bubble peaks pops tightening financial conditions via policy or rising real rates if central banks have no backbone. The constant catalyst for the pop: 4% real rates popped internet bubble, 2% popped Chinese stock bubble, 3% popped subprime. Surge in real rates from minus 100 basis points to plus 150 basis points in 21-22 popped Bitcoin. FANG, ARK, and FANG and ARK. Given significantly higher levels of global debt today versus history, 10-year real rates, currently 2%, likely needed to rise to 2.5% to 3% to end AI Magnificent Seven mania. All right. During a bubble, the cost of money contradicts the movement. So real rates go up, but the bubble still inflates. And that's like a chasing of the last remaining money that's out there. So the real rates contradict. The yields seem to have no effect for a long period of time, but they do pop during a tightening cycle. Now, I do want to draw your attention to one thing here. I don't think he said to 2.5% and 3% before. I think he said to 2.5%. So he may be adjusting, backing off. He may be. I'll have to look at it again. He may be giving it a little more room to breathe, and it makes sense given that we're not there yet as far as historic valuations go. All right, so let's take a quick look at his tables: a short history, bubbles, history, and characteristics of bubbles. All right, so the bubble, the index, the start, the peak, the rise, the decline, the velocity, the duration, the valuation. And in 12 of the 14, bond yields were up. We're not there yet, basically. That's what he's saying. Chart 2, worst equity market breadth since 2009. Chart 3, baby bubble maturing. AI baby bubble maturing. So he's thinking we're getting a little bit mature here. I don't know what that means. It means toppy, or that means near the end. Okay. Inflows to investment grade bonds. That's just a fascinating chart. Inflows to tech on course. That's it. Short and sweet. I'm Vince. Catch you later.